Learning objectives. After completing this module, learners will be able to understand how the exports and imports as a proportion of GDP, being a common measure of the degree of openness in an economy. Learn about the trade balance and account balance. Understand the balance of payments, surplus, and deficit in India's perspective. Learn the situation when a country is said to be in BOP equilibrium. Learn about the autonomous and accommodated transaction in the aspect of BOP surplus and deficits. Learn about nominal and real exchange rates and the purchasing power parity. Learn about floating exchange rates as they are determined by the market demand-supply system. Understand the relation between the increase of income and exchange rate in the economy. Learn the appreciation and depreciation of the currency values and the equilibrium state of the exchange rate. Learn about the pegged exchange rate system and how it works. Learn about the gold standard and Bretton Woods systems and their limitations. Learn the currency board system and how it works in the modern scenario in world economy. Learn how the aggregate demand acts on the income identity in the open economy. Understand the relation of the net export and marginal propensity of import in the economy. Learn about the equilibrium, output, and the trade balance. Learn about the trade deficit and its interrelation with investment and saving in the perspective of a country's economy.
Open economy linkages, exchange of money and balance of trade, BOT. The linkages in an open economy. The linkages with the rest of the world naturally establish in an open economy through three ways. Firstly, the consumers can choose between the foreign and domestic goods in output market. Secondly, in financial markets, the investors will get the opportunities to buy the financial assets from other countries. Thirdly, in labor markets, the firms can arrange to collect the workers for their works, which are being restricted through different immigration laws in the world for movement of the labor between countries. Exchange of money in international levels. Usually, when one nation's currency is accepted by foreign economic agents, then it is inevitably seen whether the respective currency can retain the stable purchasing power or not. Because there is no any specific international authority to impose any power to authenticate any international currency for the transactions. Through gold, the national currency often gives the commitment as well. There are two specific criteria as followed in this regard as the ability of the respective currency to be converted freely in unlimited amounts and the exchange price rate at which the conversions is being fixed. Balance of trade, BOT. In a distinct period of time, the potential difference between the value of exports and imports of goods of a country is called balance of trade, BOT. The exports of the goods being entered as credit item in BOT and the imports are entered in debit columns. Thus, a trade balance sheet is created. Here, the surplus BOT or trade surplus will be emerged when exports of the country will exceed and subsequently the imports deficit will arise at the time of hike in imports.
The balance of payments. The current and capital account. The balance of payments depicts all types of transactions, which include every individual, companies and government agencies, and departments' yearly transactions, which being completed with the other individuals, companies, and agencies outside the country. The current account of BOP includes the transaction in goods and services, income from the investments, and other current transfers. On the other hand, the capital account, which is eventually called the financial account, includes the transaction in financial instruments like bonds, debentures, and in the case of central bank reserves. If a country exports an item, it shows a credit in current account. But on the other side, it will import the foreign capital when that item will be paid, which will show the debit in capital account. Thus, in the point of equilibrium of BOP, the sum of current and non-reserve capital accounts becomes zero. Balance of payments surplus and deficits. Like an individual, a country sees the deficits in its current account when it spends more than it receives. It needs to sell some of its assets or arrange the finance by borrowing from abroad. It means that every current account deficit gets its money from the net inflow of the capital. Additionally, there are all the cases of official reserve transactions where the reserve of foreign exchange in the country gets decreased. This is called overall balance of payment deficits. Autonomous and accommodating transactions and errors and omissions. At the time of transactions, the above the line shows the independent mode in concurrence of profit motive in the scale of BOP. The autonomous receipts are greater than the autonomous payments and they are in surplus. But by the rate of autonomous items as transacted, the accommodating transactions are counted, which is called the official reserve transactions. The errors and omissions include those parameters which have not been recorded in balancing items due to human error. The foreign exchange markets. The price of one currency in terms of the other is known as exchange rate. Nominal and real exchange rates and purchasing power parity. Two currencies violent symmetry. The domestic currency's amount can be valued as the exchange rate to buy 1 unit of foreign currency, which is called bilateral nominal exchange rate. On the other way, when the ratio of foreign to domestic prices is measured in the same platform, is called real exchange rate. To calculate nominal effective exchange rate, NEER, the nominal exchange rate of the rupee against the currencies of other trading partners is measured in aspect of their share in India's trade and the aggregated rate depict then the NEER. On the contrary, the real effective exchange rate REER interprets the quantity of the domestic goods as required to purchase 1 unit of respective foreign goods. Here's when the real rate equals to 1. It gets the purchasing power parity. Flexible exchange rates and speculation in short-term motives. In a system of flexible or floating exchange rate regime, the central banks have no role officially to reserve the transactions as it is solely driven by the forces of market demand and supply. At the time of short-term moves in floating exchange rate systems, it can reflect speculation. In the extreme points, central banks intervene in the process despite the floating regime. The values of domestic currency can be increased to attract the foreign investment, which was driven initially by the higher interest rates, and vice versa. Fixed exchange rates. Fixed exchange rates or pegged exchange rates stay always unchanged against either the value of another single currency to a basket of other currencies or to another type of measuring, like gold. It is typically used to stabilize the value of a currency by directly fixing its value, which sets the situation more predictable at the time of trade between two countries. Exchange rate management. The international and Indian perspectives. The international perspective. The gold standard and the Bretton Woods system. The gold standard was generally used to describe the commodity-based monetary regime, but it lacked any definite form or limits over time. The actual content in the coin at that time determined the exchange rate of the currencies. When it would fluctuate between variable limits, it was set through different processes of melting and recoining of those two currencies in exchange. The official parity was thus maintained through the adequate reserve of gold in each country. The Bretton Woods system was intended to execute the monetary relations among different independent states. In this system, the external exchange rates was to be maintained within 1% by restricting its currency to gold and giving the responsibility to maintain the imbalance of payments to the International Monetary Fund. It was meant to prevent continuous devaluation of the currencies as well. International perspective. Current scenario. At present, the international scenario is categorized by several regimes. Many of them opted to change their exchange rates on daily basis, and the basic trends are evolved through the market. Exchange rate management Indian perspectives. In India, before 1990, it was somehow a selection of the nominal peg to a basket of currencies of major trading partners as concerned with the country's foreign trade. In this perspective, in aligning with the prevailing Bretton Woods system, by 1966, the Indian rupee was devaluated by 36.5%. After March 1993, the exchange rate is more or less determined by the rule of demand and supply conditions in the market. It is hereby being monitored by the principle of flexible management without targeting or pre-announcement of a band, but to allow the underlying demand and supply conditions in order to ascertain the rate movements within a distinct methodology. The determination of income in an open economy. National income identity for an open economy. While in a closed economy, we find consumption, government spending, and domestic investment as being the sources of the demand for domestic goods. But in open economy, the national income identity depends on exports and imports, while the latter would fall with foreign goods in the domestic field and thus would be subtracted from the aggregate amount. Here we can get the concept of net exports. When the exports is greater than the imports, it implies the trade surplus, and in converse, while the exports recedes, the trade deficit occurs. In order to determine the equilibrium income in an open economy, the investment and government spending are generally taken as autonomous. On the other hand, we can see that higher real exchange rate makes the foreign goods expensive. Marginal propensity to import. When a country falls in a financial crisis while importing significant amount of goods, it will affect those countries as well who are exporting the goods to that country. The level of negative impact on imports while the income declines is generally greater when the country has a marginal propensity to import greater than its average propensity level. It depicts the higher income elasticity of demand for the imported goods, which consequently causes to decline in the income level and thus proportionally downsizing the import amount as well. Autonomous expenditure multiplier and its effects. By the aid of multiplier process in an open economy, the value of autonomous expenditure multiplier uses to reduce. For an example, a change in government spending not only affects the income but impacts the rate of consumption and the recycled income rate as well. In this respect, if we see that marginal propensity of consumption turns positive, a portion of consumption will be inclined towards foreign goods, which consequently reduces the domestic income. Summary. Let us summarize what we have learned. In the open economy, the domestic and foreign goods and assets can be valued through the wide choice spectrum. The balance of payments records the country's transactions in the comparison of the world. The current account balance is the sum of the balance of merchandise, trade, services, and net transfers received from the rest of the world. On the other hand, the capital account balance is equal to capital flows from the rest of the world minus capital flows to the rest of the world. The nominal exchange rate is the price of 1 unit of foreign currency in terms of domestic currency. The real exchange rate is the relative price of foreign goods in terms of domestic goods. It is equal to the nominal exchange rate times the foreign price level as divided by the domestic price level. It measures the international competitiveness of a country in international trade. When the real exchange rate is equal to 1, the two countries are said to be in purchasing power parity. The epitome of the fixed exchange rate system was a gold standard in which each participant country committed itself to convert freely its currency into gold at a fixed price. The pegged exchange rate is a policy variable and may be changed by the devaluation. Under clean floating, the exchange rate is market determined without any central bank intervention. In case of managed floating, central banks intervene to reduce fluctuations in the exchange rate. The open economy multiplier is smaller than that in a closed economy because a part of domestic demand falls on foreign goods. An increase in autonomous demand thus leads to a smaller increase in output compared to a closed economy. It also results in a deterioration of the trade balance.